All right, let's jump right into this explainer. Today, we're taking a really deep, purely analytical look at the core regulatory mechanics of global asset disclosure. Look, for anyone out there with an international financial footprint, relying on generic tax advice or just going with your gut assumptions is a massive, yet entirely preventable liability. So we're completely stripping away the guesswork today. We're going to focus purely on the structural mechanisms, the highly actionable insights, and those strict legal boundaries surrounding foreign bank account reporting. Let's analyze exactly how this system really works under the hood. Okay, let's dive into this. The transition from a private offshore asset to a strict federal reporting requirement isn't based on your intent, and it absolutely isn't based on guesswork. It's based on very precise statutory triggers. Honestly, this transition is essentially an invisible tripwire. A lot of individuals make the critical mistake of relying on assumptions, assuming that if they don't move the money around or if it doesn't generate any taxable income, they just don't have to report it. But the reality is governed by explicit, rigid legal boundaries. Our focus right now is to uncover the exact mathematical and legal variables that instantly and often very quietly change your entire global compliance status.
Section 1, the aggregation trigger mechanism. This brings us to the foundation of the entire regulatory net, and quite frankly, an implicit assumption that so many individuals mistakenly make. When assessing their reporting obligations, people naturally tend to look at their offshore accounts in total isolation. They look at Statement A, then they look at Statement B, and they treat them as totally separate individual entities. But the strict reality of the statutory calculation requires a completely different approach. It demands a sweeping, aggregate view of your entire international portfolio. Why does the law demand the sweeping view? Because regulatory bodies view your fragmented accounts as a single, consolidated pool of potential liability. They literally completely ignore geographic or institutional boundaries across the globe. So the crucial point is understanding the precise legal mechanisms that actually tie an individual's liability to an account, regardless of where that individual physically lives. The mandate kicks in if you're a citizen or resident and you have a financial interest or simply signature authority. And having signature authority just means having the legal power to control, direct, or benefit from the disposition of funds within a foreign institutional account. Consider a really non-obvious example here. Let's say an individual is acting as a corporate treasurer for an overseas subsidiary, or maybe an adult child is given signatory power over an elderly parent's foreign bank account. Even if there is absolutely zero personal wealth of yours involved in those accounts, simply holding that legal pen instantly catches you in the reporting net.
And what is the ultimate operational trigger for these accounts? Well, it's the absolute statutory threshold of $10,000. But here is the critical detail that traps so many people. This is not about your year-end balance. No way. If the combined value of your foreign financial accounts crosses this $10,000 line at any single moment, on literally any single day within the calendar year, the reporting mandate is permanently activated for that entire year. And to deepen this analysis, we really have to introduce the highly volatile variable of currency exchange rate fluctuations. Think about it. A foreign account sitting safely below the equivalent of $10,000 could instantly breach the threshold simply due to a sudden 24-hour spike in global currency markets. That temporary, fleeting spike activates the mandate, even if you never made a single deposit yourself.
And it brilliantly illustrates the cause and effect scenario of that exact rule. Consider a fragmented setup. Imagine an individual with account A reaching a high balance of $6,000 and account B reaching $5,000. Individually assessed, neither breaches the $10,000 threshold. The implicit assumption here is usually, hey, I'm in the clear. But regulatory mathematics demands aggregation. Combined, their mass hits $11,000. Boom! The threshold is immediately broken. Federal action is required, and both of these seemingly small, entirely unreportable accounts on their own are instantly subjected to heavy federal scrutiny and must be formally disclosed. Section 2, Administrative Separation and Routing. Let's contrast these two distinct reporting paths because mixing up these administrative routes is a massive primary point of failure for many global asset holders. The implicit assumption is that all your government financial reporting just goes into the exact same filing cabinet. It doesn't. Your standard tax returns are submitted to the National Revenue Authority purely for the purpose of tax assessment and collection. However, these specific foreign account disclosures bypass the Standard Revenue Authority altogether. They are routed directly to the Federal Financial Crimes Enforcement Network. This fundamental routing difference highlights that this disclosure is strictly an anti-money laundering and global transparency dragnet. It's not your standard tax collection tool. To really cement the logic here, expert analysis notes, this reporting requirement operates under federal financial codes rather than strictly standard tax codes, representing a legal distinction that demands separate administrative processing. This concept of regulatory silos is absolutely vital to understand. Satisfying the National Revenue Authority with your standard tax return does absolutely nothing to shield you from the compliance requirements of the Financial Crimes Network. These separate agencies do not talk to each other just to save you paperwork. They operate completely independent legal dragnets. Section 3, Asset Classification Boundaries. Now, what's really interesting about this slide is the definitive, strict statutory boundary drawn between different types of global wealth. The legislation heavily targets institutional digital wealth, meaning your bank accounts, mutual funds, or overseas brokerage accounts. Why? Because the government relies heavily on systemic digital traceability. It targets the institutional footprint. Conversely, it draws a really hard line when it comes to physical, tangible possessions held directly by the individual. Those operate entirely outside of that specific systemic reporting network. The implicit assumption a lot of people make here is that all foreign wealth is treated exactly equally. It absolutely isn't. To fully understand what is required, we have to clearly define what is exempt. There are highly actionable exemptions. If you hold actual physical gold or silver coins in a personal home safe overseas, or if you hold physical paper currency in a physical wallet or a safety deposit box, these are entirely exempt. Keeping these specific assets out of foreign banking systems completely insulates them from this specific institutional reporting framework. Section 4, Procedural Timelines and Extensions. So the chronology of these deadlines is purposefully synchronized with standard annual tax cycles. The initial statutory filing deadline lands right in mid-April, with a final extended deadline in mid-October. However, this synchronization is kind of a double-edged sword. While it helps align your administrative tasks and lets you prep your documents at the same time, missing the standard tax deadline often creates a pretty severe cascading failure, where the foreign account reporting deadline is missed simultaneously, and that triggers entirely separate massive financial penalties. But we really need to highlight a highly actionable, non-obvious procedural mechanism regarding that exact timeline. That 6-month extension from mid-April to mid-October, it's applied entirely automatically. This is a rare moment of frictionless administration in an otherwise extremely strict regulatory environment. Just contrast this with standard tax extensions, which, often require proactive, highly scrutinized preliminary paperwork. Understanding this administrative shortcut prevents unnecessary panic, it eliminates redundant paperwork, and it saves significant operational time for anyone auditing their own compliance. Let's move to Section 5 and see how this builds the broader reporting ecosystem. We really must contextualize this single disclosure within a much wider, way more complex web of international financial reporting. Triggering this basic account report often acts as a critical entry point for regulatory algorithms. It has a real cascading effect. Depending on your specific setup, filing this one report might flag the system to look for specified foreign financial assets exceeding completely separate thresholds. It might look for transactions involving foreign trusts, overseas inheritances, ownership in passive foreign investment companies, or stakes in foreign partnerships.
The regulatory net is like a giant puzzle, where laying down one piece inevitably reveals the others. Which brings us to a final, pretty provocative consideration. We now know the precise mechanics. Invisible aggregate math dictates your status. There's a distinct criminal enforcement routing totally separate from normal tax collection. And strict, rigid boundaries exist between heavily targeted digital assets and securely exempt physical ones. So, armed with this expert-level understanding, how is your global portfolio currently categorized? It's time to actively pressure test your own compliance assumptions before federal regulatory algorithms do it for you. Thanks for joining this explainer.